I've done that is to try to tonight. Do I have any newcomers here tonight? If I have any newcomers, this is your first trading lab. I want of their entire trading career. Several people made more money today than they've ever made. And so that's the flip of the coin. And I don't say that to rub in the face of some of you who didn't do as well today. I say that to say that there is still hope. There's always hope. And so please do not feel tonight desperate. Please do not feel like you're in trouble. Please don't feel like you're stupid for not knowing something better. That is not the reality. Those are all voices in your head, and we can get past all of that. Okay, so that's what I want to really encourage you. The other thing I want to encourage you tonight is this picture that you're seeing on the screen, and everybody should be seeing the market today. Everybody should be seeing my screen. Let me zoom in just a little bit. That picture, which looks like just a cliff. I mean, you can't get more cliff looking than that. This picture is just a picture. That's all it is. And I recognize that for many of you, that reflects in a large percentage loss of your trading accounts. I recognize that, especially if you're in mutual funds, especially if you have broad market exposure. I recognize that. But I really want to encourage you to dig a little deeper and to realize that money is not the answer to everything, and money is not your ultimate security. And so there is always another day, and the sun will come back up. Next week will get here, next month will get here, next year will get here, and we will keep moving forward here. And I promise you that this too shall pass. Now, with that as a preface here, let's get into this and let's talk about this proverbial bloodbath that has been going on Wall Street. And let's talk about some of these great things that are going on. Now, for those of you who can see this without emotion, today was a roller coaster. And if you're not emotionally involved, wow, this was a great ride. For those of you who are emotionally involved, it's scary. It may be one of the scariest things you've ever experienced. But to those of you who are not emotionally involved, all you can say is, whee, this is fun. Now, again, I don't say that to be disrespectful to those of you who are not having fun in a bear market, but I'm just saying it to say that, you know, it's the nature of the market. And you turn on the news. I mean, I was watching the news this morning. I was watching futures overnight. I saw this thing coming. Of course, the Chinese market just was demolished overnight. I was sitting at the Titans preseason game last night, and I couldn't put my phone down. I kept checking quotes, and I had some Forex trades going on, and my buddy and I were sitting there and just kind of updating the market. We're watching futures, and all night, I mean, just saw this thing come. And I woke up this morning, and I was like, oh, my goodness, this is going to be a tough open. And I was watching the commentators this morning. And I don't know how many of you watched the market open on television, but it was interesting. You know, I've been trading the market since 1999. I don't recall seeing this kind of panic. In 2008, I was in St. Thomas, Virgin Islands during the 2008 panic, and I did see similar commentary. There was a lot of panic during that moment. But I think people kind of saw some of that coming. Anytime you get into the first wave of a bear market, a lot of people are really shocked. And I think that's really where I want to start with my analysis tonight. You know, why is it that a 588-point day that actually looks great compared to what it could have been? I mean, you start the day off down 1,000 points, 1,100 points. You start hearing these things about circuit breakers and stuff, and, you know, your gut starts to kind of turmoil a little bit. Unless, of course, you bought puts on the diamonds, and then you're cheering. But, you know, if you didn't buy puts on the diamonds, your gut's kind of saying, oh, my goodness, can I sustain this thing? And that's exactly the same sentiment that the news commentators were taking on. And it's the sentiment that you saw across the country today through so many different outlets as people talk about the quote-unquote bloodbath, or you heard a lot of different terminologies. And then the natural reaction, and if you're making notes, I want you to write this down. The natural reaction of all news media is to immediately look for a cause and find something to blame. Write that down. The immediate reaction of all news media is to look for a cause and find something to blame. Now, 2 weeks ago, whenever I did Power Trader, and I set these triggers as a bullish trigger at 17,676 and a bearish trigger at 17,329, I had no idea that we were going to see a 1,500-point drop in 3 trading sessions. I had no clue that that was coming. None of you had a clue that was coming. All we were doing is we were looking at the trading sentiment, and we said we've got lower lows and we've got lower highs. And if you were in that power trader a week ago, not last night, but a week ago last night, you remember what I said. I said very simply in my trade setup, and this was sent out in our trade setups for the week, so you can go reference it. I said watch for the Dow to rally to about 17,600 and then sell off with the first target of this support. And if that doesn't hold, then you're looking at 16.5. And if that doesn't hold, you're looking at the lows from October. Now, that's what I said a week ago. And I had no idea that this was going to happen in 3 trading sessions. What I did have an idea of is what the trading sentiment was telling us before all the news media had to go look for something to support the bear market. The news media goes out to find a story to support what happened. The quality analyst goes out to say what's the trading sentiment that supports what is likely to happen. There's a very important sentence that I just said right there. The quality analyst looks at the trading sentiment to see what could happen. What supports what could happen, not what explains what just happened. Why is that such an important piece of information? Here's why it's a piece of information that you care about. Because as a trader, you need to be aware that you could get into a bearish trade at 17,329 and that there's structure for that. A news commentator simply says this is what just happened and oh my goodness, what are we going to do? The news commentator, for the most part, has put their money in mutual funds. They've trusted somebody else to manage their money, somebody else that may not even have a clue what they're doing with their money. And they've trusted this person who has gone out and bought all these long trading positions, assuming that the secular bull market is going to continue and that it's going to continue for a long time because every 20 years markets go up. And whenever they start to see the market selling off, what do the news commentators do? They have to find someone to blame other than themselves. That was a really important statement I just made. Finding someone to blame other than themselves. It is so easy to blame someone else. In fact, it's human nature to blame somebody else. When we do something that we don't like, we don't want to take the consequences. What do we try to do? We try to say, well, such and such did this to me. So today the story is China. But I'm going to suggest to you that China is not the story. I mean, yeah, so crap is happening in China, but it's been happening for over a month. Why is it suddenly a story on August the 24th? You know, what was it, 2-3 weeks ago, China sold off 8% in a day, and they started to, you know, we saw follow through in the Dow, and then they were blaming China too, but China had been selling off for a month. So why is it suddenly, after China has sold off 20 or 30%, now overnight, literally overnight, now it's a worry? It doesn't make sense unless you're the news media looking for someone to blame. So what's my point here? Here's my point. Our goal as traders is to look at the sentiment that is setting up, and yes, I'm going to tell you boldly, we did see something coming. I've been talking about it for the whole year. I've been saying that this is a topping pattern. I don't know when it's going to break. I've been frustrated that it hasn't broken one way or the other, but we've had every reason to believe that a bear market was ensuing. I don't know how many times over the last 4, 5, 6 months we've talked about the Dow Transport, Dow Industrials divergence. I've given you my thoughts on it. I've said, hey, this is a warning sign. It has a checkered past, but it is a warning sign. We've talked about divergence. We've talked about market breadth. We've talked about so many warning signals. And then over the last 3 or 4 weeks, we talked about the reality that the moving averages and the moving average trading system has given us a bearish signal. We're below all 3 averages. We're solidly below them. We're making lower lows, lower highs. We got moving average crosses. And based on just this trading system alone, a week ago, I was able to say we should rally up to about 17,600 somewhere in this range. If we keep going, then we'll trade it on up. The consolidations continue, but if we get to 17,600 and it turns down, that's the perfect opportunity to start selling the market. And sure enough, that was the perfect opportunity. We rallied within, I think it was 32 points of my 17,600 target. And then, of course, the bear market ensued. Now, let's talk about what really is causing the bear market. It has hardly anything to do with China. It has hardly anything to do with the Federal Reserve fears. It has hardly anything to do with the news, what the news media is talking about. Here's what it has to do with. The market sentiment has shifted. You want to put it on a bumper sticker? What caused today's sell-off? Answer. Market sentiment has shifted. We've seen the market sentiment shift from our May highs of just over 18,000. We've had nothing but a sequence of lower lows and lower highs. All of our sequences of swing points have been lower lows and lower highs. All of them. Now, for several weeks in here, we talked about this in trading labs, we've talked about it in power traders. For several weeks, we've had divergences where the S&P was very neutral, the NASDAQ was still a little bullish, and the Dow was a little bearish. And so we were saying, you know, markets are pretty neutral, but, and what did we say? We said the Dow's very bearish, which may be catching up to the transports. The S&P and the NASDAQ will either follow suit, or the Dow will break out of this thing and we'll get into a continuation of the bullish market. When you're in a consolidation, when markets are going sideways, you don't really know which way things are going to break out. You're just watching for the breakouts. And the best leading trade setup here has been with the Dow Jones. That's why I was trading diamonds. That's why many of you were trading diamonds, because this was the leading indication here. We didn't know that the NASDAQ was going to do that yet. After last week, we had a good idea, but you know, initially, the leading move here came from the Dow. It was the perfect trade setup. And so what do? You start shorting the market, you start buying diamonds or whatever it takes, and then sometimes you get really blessed, and you get a really massive move like this. Now, what causes a massive move such as this? Let me tell you what it is. I'm not the only one who is smart enough to look at this bear flag and say that's a continuation pattern. I'm not the only one who sits here and says we're below all the moving averages, 10, 20, and 50 period. We got a moving average cross, and if we rally back up to the 20 period and turn down, and we get a little evening star reversal formation here, and we keep going down, I'm not the only one that looks at that and says, man, this thing's going down. And by the way, when you look at the market as a whole, you have to agree this has been a pretty good bullish market. I mean, from 2009, when we're down here in the 7,000s, and you push all the way to 2015 when we're over 18,000, that is a pretty darn good bullish market by most people's measurements. Now, I know some of you might be more optimistic than that, but yeah, I have an idea that most of you would agree that's a pretty bullish market. Anytime you have that much profit in a trade, at some point you start to say, it's time to take my money off the table. So what do you think happens when we start to see trend lines getting broke, and more importantly, when averages start getting broke? You have situations like last October where we had panic selling. You have situations like 2011, 2010 where we had panic selling, and you have situations like 2015 now where we have panic selling. Now, what's different in this panic selling and what we saw in 2014 in October? Well, what's different here is the level of the trend that is reversing, I believe, is different. Look at these trend lines. I got so many lines on here, it's hard to see. But if I can draw your attention here to this line, I'm highlighting it here. There it is right there. Look at that trend line. This is the trend line from 2009. That is the bottom of 2009. That's your trend line. And that is the trend line that just has been broken. And it didn't just get broken. I mean, in 2012, we had a little breach. In 2011 or 12, right there, we had a little breach. Certainly in 2011, we did. We had a little breach last year in 2014, but all of those quickly corrected. We do not have a little breach of that trend line. This is called a massive breach. As one commentator put it, the dam has broken, and everything is flowing out. The reason we see panic selling actually has nothing to do with China. It has everything to do with the same fear that you feel in the market right now. You're afraid, and for some of you, you were afraid last week and you got out early. Some of you saw the opportunity and you got into bearish trades, and some of you didn't realize it until Friday. And on Friday, your face looked a little bit like this, and you were holding on saying, maybe Monday it will work. Maybe Monday we'll bounce back and I'll have another chance. And then, of course, this morning, markets opened up and just the bottom fell out, literally. And now the shock has turned into tears as people are saying, what do I do? Do I sell now? I don't want to be selling at the bottom. People are saying, do I wait for a bounce back? Well, what if it doesn't bounce? You know, maybe this thing goes down to 13,000. You know, maybe some of these doom and gloom people are right. Maybe this thing's going all the way down to 5,000. I don't know what to do. And so the fear is high. The confusion is high. That's why you see the volume high. That's why you see the panicked buying and selling. And that's why you're here tonight looking for some answers. I can't give you a perfect answer, but what I can give you are some models, and we can start to kind of get grounded. And that's the best thing that I can offer for you if you were on the wrong side of the trade. Now, if you're on the right side of the trade, we'll talk about the bearish trades and how that's going to shape up moving forward. If you're still holding bullish trades, we're going to talk about where your chances to get out are and how you can jump in to maybe hedging yourself and what you want to do moving forward. We'll talk about some of that stuff. But the real issue that I want to bring to your attention is this panic has very little to do with China, in my opinion, and it has everything to do with trader sentiment. And we've been seeing the trader sentiment rolling over. If you want to talk about a rounding top, there's a rounding top. It's been rounding out for months. I mean, if you want to talk about whatever argument you want to make, I feel like the market has been speaking to us, whether it be breadth, whether it be divergences between the transports and the industrials, whatever it is. I think the market has been talking to us. Last week, I think it was in Trading Labs. Last week, we talked about the Ichimoku clouds. Last week, just 1 week ago tonight, that's not what I meant to do. Just 1 week ago tonight, I put this picture up here, and I said, according to the Ichimoku system, this is a bear market. This was just a week ago. And look at where we are today. So did we have warnings? Yes, we had plenty of warnings. Now the issue is not did we have warnings. Now the issue is how do we react and what do we expect moving forward. So let's talk about that. One thing I want to draw your attention to is where the market sold off to today, just below 15,500, exactly right around 15,380. Do you think it's a coincidence that I have a line right there? This happened early this morning, and it bounced up. And if you come back and you look where that line came from, look, you're right here. It is the bottom from January, February 2014. That was your support level. Now, I'm shocked. I did not think we were going to sell off that far. I mean, I told you guys last week, 17.1, yeah, that's easy. 16.5, you know, would be good. And I've been saying and anticipating around 16,000 for the first wave of the selling pressure. That was kind of my ideal target. I think it's interesting that we closed today just 120, 130 points below that target of 16,000. 130 points sounds like a lot, but when you're put in perspective of 1,100, it's not that much. So I think it's interesting, and the more important thing to recognize is support is building. So there's another note for you. Support is building. Support is building. Things do not go down inevitably forever, immediately. Panicked sell-offs turn into frenzied buying. There's a bumper sticker. Panicked sell-offs turn into frenzied buying. And so at some point, whether it be tomorrow morning or Wednesday or Thursday or Friday or maybe next week, at some point, you will see a frenzied rally. And that rally will look as bullish as these days are bearish. I would not be surprised to go ahead and write it down in your notebooks, and let's see if this prophecy comes true. I bet that in the next, we'll say in the next 2 weeks, but probably in the next week, we will see a 500 to 1,000 point positive day in the market on the Dow Jones. Now, how would I make such a broad, random statement? Because I've seen these things before. I lived through 2008. I was trading through 2008. I've experienced it, and I understand when volatility goes this high, that volatility is not just on the bearish side, but it's also on the snapback reactions. And so that's what I want to talk about. We've got support that is building. We've got several layers of support in here. We hit probably what will become the floor. I cannot prove that yet because I've not seen this thing end yet. We don't have the actual signal that this is the bottom yet, but we have hit what will probably be the short-term floor. And write that down, short-term floor. I'll put it on the screen. I do not want anybody to come back to me when this floor breaks the next time and tell me I didn't warn them. Short-term floor. I think we are close to that, right around 15.3. I think this may be the bottom. If it breaks below that, you're looking at this next level of support down here, 14, what is that, 14.8? About 14.8. Those come off the lows from 2000. Oh, shoot, my scaling just messed my eyes up. Let me figure out where I'm at here. 2013. All of this support that we had back here, that would be the next level of support. And if 15.8 does not hold, then, or sorry, 15.3 does not hold, then 14.8 would be the next level. Now, most of you don't know Elliott Wave Principle. I'm actually teaching a mastery class on this Wednesday night, so you're welcome to come watch it and join it, and you'll understand what I'm about to say. This is a third wave. This is in all likelihood a third wave, and third waves typically have a fifth wave. So that fifth wave could just be a close down here around 15.3. It could be a push all the way down to this lower level. So in the end, this whole move will probably look something like that. And then it will bounce. That will, if you're not out by that point, then that will be your chance to get out. Now the issue is how far will it bounce? Because people often say, well, I'll wait for the big bounce and then I'll sell. Well, the challenge is this right here. Does it retrace 30% to 16,000? Does it retrace up to, 50%, 16.5? Does it retrace almost 100% to 17.3, 17.4? Last week I would have told you that when this thing bounces back up, it'll probably come all the way back to 17.3. I don't know that anymore. It may be that 16.5 is as high as we bounce here. But here's what I can anticipate. I can anticipate the way that this move will shake out for you here. Let me, I'm trying to get a white screen on the board here. So let me, can you guys all see my white screen? Is that working for us here? Yeah, that's working. All right. So let me draw this out for you here and see if this gives you any help in terms of the way that markets move. I'm trying to look, you can't see it, but I'm looking to see if I have a slide actually already created to help draw this out. I'm not sure that it matters if I do. It's probably easier just for me to draw it out, so I'll just draw it out for you. So here's what we see in bull markets. During bull markets, we see a belief building phase. It's going to look something like this right here. And if I were to write this up here, you just call this belief. Belief building. Okay, then you're going to see a move where it's going to be continuing the bullish move. And we're going to get to the point where you reach some sort of maximum optimism. And then the doubt starts to come in. And that says doubt if you can't read it. And the doubt, this is where the last gasp starts to show up. Now, once the last gasp comes in, we usually have the first bearish thrust. And this bearish thrust can be a really big thrust. It could be, it may be about what you see here. But we're going to have a lower low. That's the point here. And if you were to write on the screen what this is defined as, it's really just a lower low. Okay? Now, there may be some fizzle and fazzle in here. This is really what we've got in our market right now. We had some fizzle and fazzle, as I like to call it. Fizzle fazzle means it's just moving sideways. And then what will happen is it has some sort of a thrust where fear is starting to build. And usually early on, it has a big bounce back. And this is a retesting. I should have drawn that in a different color, but let's put this in black. Oops. There we go. This is a retesting. Okay, and then once the retesting is in, it's still not the right color. There we go. This is actually the biggest sell-off right here. And this is when we get to the point of maximum fear. And then we get down here to the bottom where nobody believes in the market. We have some sort of a bounce, and then we have a final sell-off. And at this point, nobody wants to be involved in the market. Nobody. And guess what? That's exactly the time you need to be involved in the market. Because here's what it does. It goes from there, and it just does this. And how the cycle then moves is the cycle then turns over into some belief building or optimism. Another word for this is hope. And then all that belief and all that hope builds all the way through here, and eventually the whole cycle continues. Now, the reason I drew all this in black is because I think I have every reason to believe that we are right here. I have every reason to believe it. That in this kind of idealized model, that's where we are. I do not think that we are here at the bottom. And I don't think that because I think that we are in part of a bigger cycle. You'll actually understand more of that after my Wednesday mastery class. But I think if we're getting into a prolonged bear market, which I think we probably are, then this is where we are in the cycle, which means we're going to have a rally, we're going to have a retest, and then that's where we can re-enter the market. Now, if we come over here, let's get rid of all this stuff here. And let's get back over here into the market. What does this look like to you? We had all of the belief building all through here. There's all your belief building. There's all your optimism. We've been building this thing for years. And if you want to keep cycles in perspective, we've been building this thing for years. Oops, that's the wrong key command. Let's try this again. Since, what did I do? Oh, it's the wrong, there. I'm pushing command, that's why. I'm supposed to be pushing the control key. There we go. We've been building this thing for years. There we go. And so if this thing is going to correct, what is correcting? What's correcting is this entire wave is correcting. That means you can't look at the last year. You got to look at the entire sequence of the wave, which means the odds are anywhere from a 30 to 66% correction of that entire move, if this is truly the real corrective move of the big primary trend. Now that scares people, because that means that if you're looking at this, let's just throw a Fibonacci line on here. If you're looking at this and you're thinking, how far could this thing retrace? Well, we're talking about anywhere from 13,752 would be a 30% retracement, 12,300 would be a 50% retracement, and 11,000 would be a 60% retracement. We got a long ways to go to get down there. And so it makes the most sense in terms of the cycle. If you look at the way the cycle has laid out, this is all the belief building, all that bullish cycle I just showed you. Well, what's all this at the top? This is a topping pattern. This is the first of probably many bearish thrusts, and this will probably retrace. This will retest, and then it will continue bearish from there. And that will make the first bearish wave of what will become probably part of a bigger bear market. Now, why do I think this is going to be a bigger bear market? The reason I think it's going to be a bigger bear market is because if you look at the big pictures here, and I'm going to go up to a weekly chart. Look at these big pictures. In fact, I think it makes most sense to get rid of all these lines because these are daily lines and some intraday lines. Just look at this picture from 2000 forward. Okay, so recognizing this picture here, you see this is the trend that is getting broken. This big long trend from 2009 forward. There's no way to mistake that that is the trend that is breaking right now. If this trend continues to break, let me scoot this over so I can draw. Let me, can I scoot over? Come on, Trade Navigator. It's not going to work for me. All right, well, we'll still make this thing work. All right, so if this trend right here is the one that's getting broken, then as you look at the probable future direction, you realize that it's this first sell-off that will come back and retest as this trend does something like this moving forward. I expect after the retest, this wave is the one that will be the most scary. That's my hunch. So I'm just preparing you right now that if I'm correct in this, the next bearish wave will be more scary than the one we're currently in. Now, I don't say that to spark fear. I say that to just prepare you. This is what the chart is telling me. If we look at the moving averages on a weekly chart, so I'm not on a daily chart now. I'm going to look at the moving averages on a weekly chart. Look what's just happened. My weekly moving averages have all crossed, they are all crossing bearish. Right now, we are solidly below them. My moving average system is turning over. The same way we saw it on a daily chart, we are now seeing the weekly trends moving over into a bearish trend. This is going to rally, and then it's going to sell off. This is the trend level that I am the most concerned about. The daily trends are scary day to day. The weekly trends have a substantial impact to the overall economy, to your overall 401ks, your overall mutual funds. This is bad. Since 2009, one time, we had this scenario. And what did that create? If you're familiar with my lines on this chart, I'll put this up here. Most of you are probably not familiar because it was so long ago. But at the time, what we were looking at is this trend line right here, the one I've just done in red. That was the primary trend at the time. And when that broke, we were very prepared for a bearish market. And instead of the bearish market coming in, we got a fan line. And that is the fan line that has carried us all the way through. So, in fan line theory, there is a third level. Could a third level of fan come in right where we stopped today and carry us higher to 19,000, 20,000, 25,000? Yes, it could. What a bullish, this is a decelerating fan line. What a bullish decelerating fan line ends up looking like is a slowing down of the angles of the trend. So is it possible that from where we are right now, we could have bullishness come back in and continue to make higher highs just at a lower angle of attack? Yes, that is possible. That is a long-term view that I've talked about for many years now. I don't talk about it often because it's not been relevant until today, but now that it's relevant again, we'll talk about it. So it is entirely possible this would be the third fan line, and when this one breaks, if that is even true, and I don't know that it will be, but if and when that one breaks, then that's where the big sell-off happens, the bigger trend reversal. That is a possibility. But back to my point here, when we look at the weekly chart and we look at the moving averages on the weekly chart, I think it is fascinating and not insignificant at all to recognize that only that one time since 2009 have the short-term moving averages, that's the 10, 20, and 50 period. So in terms of the weekly chart, it's a 10-week, 20-week, and a 50-week moving average. Only once have we actually had the full crossover. And none of these, neither out of these two, I just said it once. The one before, that's what I'm trying to say. The one before was not nearly as bearish in terms of how far it had sold off. This one today and yesterday and Friday, much further below these averages. So this is a big deal. Now look over here to 2007. Boom. What do you see in 2007? Let's just use this as a model. Try to keep it all in the chart here. If we look at 2007, you notice all the belief building phase. There's your head and shoulders. It sells off, and now what happens? It rallies for the retest. In the model, I believe we are here right now. Notice what happened at that time. During that first phase is where the moving average cross came in. We had a rally slightly above it, but in this case, the moving averages did not cross higher, and that's probably going to happen again. In the bullish side of this, moving average crosses, it comes back down to the averages. The averages, again, did not cross, and then the trends continue. So if you come over here and you look at where we are right now, zooming in a little bit, it makes the most sense that over the next 2 to 4 weeks, at some point, we have a rally that connects with these moving averages. And then sometime later this fall, probably in October, because that's when it always seems to happen, then the next wave of selling pressure will happen. Now this candlestick, I want to point something else out. This candlestick is just today, because that's all that there is for this week. If this rallies and we end up back at 16.5 this week, look at what it will look like on the weekly chart. That is the perfect place to have a long lower shadow. If it were to rally this week and we'd ended the week at 16.5, and you can write this one down in your notebook too. If it rallies this week and we end at 16.5, it's the perfect place to have a long lower shadow. And that is almost a guarantee that next week and the couple weeks after that will probably be bullish. These averages will all get caught up. And then, for those of you who want to be short again, that will be your next selling opportunity. And it will be longer and further and possibly faster than the first wave of selling pressure. And that's scary to a lot of people, and I understand that. But I'm just telling you what my anticipation is, and I'm not the only nut job that's talking like this. Let's talk about, I think I've probably talked enough about the big trend here. I'm happy to address more on that subject, but I think I've talked enough about that. Ultimately, in my opinion, a 30 to 60% correction, and let me give you this. So, you know, a lot of times we talk about trend reversals and when the trend is fully confirmed. On the daily chart, the bearish trends are confirmed. Let's come back to the daily chart for a minute. On the daily chart, we always look at, we say when you have a sequence of lower lows and lower highs, there's your 3-point reversal. Well, there it was. We've got that. Now, if you go up a fractal to the weekly chart, we don't have that yet. So what we're looking at on the weekly chart, you will know that the bear trend is here. I'm back to the weekly chart. When we have the lower low, you have a lower high, and it continues the sell-off. There'll be your weekly chart 3-point reversal for that fractal level. And if you zoom out, once that is confirmed, I would anticipate a minimum of a 30% correction. And it could go as high as a 60% or more. And really, the technical number is 68%. And it's not 60% of the whole market. It's 60% of that move. Now, let's go another level up here. The belief by some, and I'm on the fence. I don't know what I believe. But the belief by some is that this wave that we are in is part of a larger structure that is correcting. I'm going to have to go to a monthly chart to show this. The belief by some is that the wave structure we're seeing right now is part of a wave that is correcting essentially this move right here. And that's the first A, this is the B, and they're looking for a C wave, and if they are correct, C would bring you below 5,000. You think you're scared today? That's really scary. Now, the good news is it won't happen overnight, but it will happen over time. And that's, you know, that could be bad. Now, I don't think it's scary. I see it as an opportunity, and I hope you guys do too. I may be talking Greek to you here, so in case I am, I'm talking about some Elliott wave structures here. That's what I'm getting into. I don't want to get into teaching that tonight. I will be teaching it on Wednesday night. It just so happened. I mean, it's a miracle. I lined these classes. I had no idea when I planned this mastery class that we'd be talking about this week. But you know, if that is true, if the Elliott wave model that Robert Prechter has put out there is true, then this is just the beginning. I don't know if I buy into that. I'm very much on the fence. Harry Dent, who's an economist that I very much respect, he completely, for different reasons, Harry Dent also is supportive of Dow 5000. Some other economists that I very much respect are supportive of Dow 5000. But there's a lot of other economists that I also respect that think that they're nut jobs. So they may be nut jobs, and let's just hope for the sake of everybody who doesn't know how to handle that big of a sell-off that they're nut jobs. You get into the less nutty economists, people like Art Kaysen, and they're saying definitely this current wave has to correct. And we're looking at a potentially 30% to 50% correction of that wave. And so that puts us, you know, maybe Dow 10, 11,000. I think that's very reasonable as a minimum. If this prolonged bear market really takes hold, I think that's reasonable. And that's going to make it look like, you know, today was actually a good day. So, you know, we've got to keep those things in perspective. I don't think you need to freak out about it, but you got to keep in perspective. All right, let's bring this thing closer to home. Let's get into more timely discussions. Coming back to our daily chart now, here's what I'm anticipating. Let me get my lines back on here. Here's what I'm anticipating. I anticipate that tomorrow or the next day, we will see the bottom for the short term coming in. That's what I anticipate. It might be where we sold off to today. It might be that tomorrow we open up and we look like this. A lot of that's going to depend on how international markets behave tonight and how much fear people are willing to take in overnight. Because what happens is when you start breaching these support levels, it starts triggering trades. A lot of you had stops that were triggered today. A lot of traders had stops that were triggered. And when you start triggering trades, you know, it almost becomes automatic that you have sell-offs. And then, of course, you start to have the fear and people being irrational and all sorts of stuff happens. So if tomorrow we get a nice bullish candle, then you can assume we're going to get a rally somewhere. And 16.5 is looking like a pretty good rally point. Initially, I thought it was going to be higher, but I didn't anticipate we'd sell off this far. So my target right now for a rally might only be as high as 16.5. And I probably will not buy calls for that trade. I probably will not take that trade. So that's maybe the good news here. That's the silver lining. That could happen in one day, by the way. That could literally look like this tomorrow. Or it might look like this. And then it could look like this. And if you think that can't happen, then all we have to do is we have to go back to 2008, and I'll show you what real bear market fear looks like. Let me come back over here. And when you get in here, you start to see, wow, these were really big days. May not look that big right now, but they were freaking huge at the time. And what we had is we had, you know, a few 100-point sell-off, few 100-point rally, another huge rally, another huge sell-off. These were hugely volatile days, huge volatility. And, of course, all the plummeting. This was a 1,000-point day right there. Just to give you perspective, that's 1,000 points intraday on October 10th, 2008. So I expect that that's probably what we're going to get into again, where we have just really wild volatility. And in the time being, it looks huge, and in the future, you'll look back and you'll say, well, it doesn't look that huge, but when you live it, it's huge. So be prepared for that. The other thing that could happen tomorrow, and we're going to have to just kind of keep a pulse on it. You know, I don't think that right now the futures are up a couple hundred points, but I don't think that the futures right now are going to indicate how we open tomorrow. We're just going to have to wait till we get closer to tomorrow morning. But you know, the other thing that could happen is we may come back down and test this 15,300 level. The Asian markets right now that are open, the Australian market, they're getting just hammered. And so, you know, if China continues that when they get open, if Europe continues it, there's a good chance we could see some more selling tomorrow. But I'd really keep my eyes on this 15,300 level. I think that's going to be the bottom here in the short term. And I expect we'll rally up to about 16.5. Maybe we'll get all the way back up here to 17.3. But when that happens, you better believe there's going to be more selling. And the reason for that is all the people that didn't get out last week when they had the warnings, when the next time the stocks get up here to 17,000 and their trades start to go higher, they're going to say, I didn't get out last time, I'm getting out this time, and I'm taking my profits. So that's where the sentiment's coming from. All right, I've done a 50-minute market overview. Has this been beneficial for you guys? I mean, is this helping y'all? I know it's kind of been a little bit long. I don't think there's anything else I need to add to the NASDAQ. I don't think there's anything I need to add to the S&P. The dollar index is a little bit interesting. It sold off much more and much faster than I expected, and I think we are at the point where we're probably looking for the move to start going the other way. In fact, it's already started here. Look at that. So we got a pretty good long lower shadow. This is a continuation of the consolidation that we had. Get a little bit more confirmation here. The dollar will probably rally back up to about the 98 range. On the euro, that's going to look like a sell-off. This is probably happening right now. I had targeted 14,004, or not 14,000, sorry, I'm thinking other numbers here. I had targeted 1.1440. That's where I had gotten out, which was these highs here in May. I'll probably let this form a little bit more. Evening star reversal, tweezer top, any of those formations. And then you start shorting euros with a target down here. That's probably, you know, that's your reasonable target down here, about 1.086. And maybe it'll sell off on down to 1.05. But this is part of a larger consolidation that is continuing. Let's talk briefly about what the Fed is going to do. And the answer is I don't know. I have an idea that if this formation, it's a little far out, but if this formation that I've just talked about, if it forms like this, where we get all this buying pressure comes back in, and if we get back up into the 17,000, 17.5 range, I drew it into October, but it would need to be in the next couple weeks here. If we get up there by the time the next Fed meeting happens, I think they might go ahead and raise interest rates, and that might be the news that becomes the impetus for the next wave of selling pressure. The selling pressure, however, does not come because of the Fed. It's just that the news will blame the Fed. The selling pressure is already here. The bear market is indicating that it's here. Now, what could derail a bear market? Well, let's say in September, I don't think this will happen, but let's say in September, the Fed says quantitative easing 4, QE4. Holy cow. If they did that, then they're just feeding more crack to the masses. I don't think that's going to happen because the Fed has been pretty clear that they want to get out of this reliance on their easing policies. So I don't think the Fed is going to do anything like a QE, which you were hearing on television today if you were listening. I don't think they're going to do that until we have a much stronger sell-off. And you see some illiquidity in the debt markets, so the credit markets, I should say. So you know, I don't think that the QE4 is a real possibility. I'm not sure if any of you were going to ask me about that, but I thought I'd go ahead and preempt that. I do think it is still a 50-50 chance that in September they will raise rates, and if they do that, that will become the impetus for that. That will be the final straw for a long-term bear market that will last into next spring and probably into next summer, and probably have major implications in the presidential election next year. Let's see, other things that are worth talking about here. Yeah, that's probably all I need to talk about. Let me take some questions, and I'm sure other stuff will come up. Is that good? Do you guys feel like you got a good market update here? And by the way, do you feel any encouragement? I mean, is anybody feeling any encouragement, even though I just told you the market might sell off for the rest of the next 2 years? What do you do about it? Okay, that's a good question. Well, you know, I can't tell you what to do with your individual accounts. What I can tell you is what might happen. So, you know, you can go to cash. You can hedge your individual portfolios if you've got a larger position. Let's say you got a 401k that you don't have access to. You can always hedge that. You can go look at our Options Made Simple classes to help understand that better. If you want to streamline that, go to options for hedging. You want to streamline this, go to Options Made Simple 201 class 1 and 2, maybe class 3. I think it's just class 1 and 2. So that's where you can learn about hedging more. And there's a formula in there for hedging an overall portfolio. So, you know, if you've got a 401k, you got mutual funds, and you need to hedge that, then that is one way you could do it. Other than that, I honestly, I don't like to trade against the trend. You know that. So my belief here is you buy bearish trades, and when the market rallies and it turns back down, just like what we had last week on a small scale. In fact, this is a really great thing for me to show you here. Last week we had a rally and a sell-off. The next time we have a rally, it'll be larger scale, and the sell-off, that's when you start selling again, or you either short again or you buy puts. So that's what you're watching for. And by the way, that'll be broad. I mean, we're talking about the Dow Jones here, but I think it was literally 99%, maybe 98% of trades were down today. They're like all down, all of them. And that'll happen in the future. So, you know, that's how you can kind of prepare for that. I hope that helped you out there. Let's see. There's a lot of lessons we learned today that I could talk about. Let's just see where I should start here. So, moderators, what have you flagged for me? What have you flagged for me? Where shall I jump in? I just read Dan's question, even though it's right at the bottom. I'll just answer it real quick. Dan wants to know, can I get caught shorting a stock and not able to buy? Yeah, you could, but normally the shorting, it'll be the other way around. They put some rules tightening the shorting. In a bear market, they want buyers. So what you'll run into is probably not the I can't buy. I promise somebody's wanting to sell, Dan. The issue may be an issue of the spreads. That was a big lesson today. How many of you noticed this morning, if you were watching the live markets, did anybody notice how wide the bid-ask spreads were? On the diamonds, the bid-ask spread was 4, and at one point it was $5. The difference in the bid and the ask was $5. That's a scenario, Dan, where, you know, I would love to have sold on the bottom tick at 15.5. I could not sell my diamonds when we were at 15.5 because the spread. They were quoting $12 and $12 for the ask, and they were only offering $7 for the bid. And I'm like, I'm not going to do that. So by the time things stabilized, you know, the market had already come back up, and you know, I can get out now when the market's at 16,000, but you know, that's 500 points different. And so, Dan, that is a possibility where that spread widens, and you wonder why that spread widens so much, because the market makers are trying to figure out what's going on too. That's why it widens so much. Okay, Travis wants to talk about a circuit breaker, and his question is, can a stop fail like in a circuit breaker? All right, let's talk about the circuit breaker and the Rule 48 and all that stuff. Circuit breaker is a rule that was, or it's a mechanism that was put in to stop a sell-off panic. And the way that it works is if the market, I think they base it just on the S&P. I don't think they factor other indices. I might be wrong on that. But the issue is if it's down 7%, that reaches what they call a level 1 circuit breaker, and that halts trading. I think it's for 20 minutes. It may be 15 minutes, but I think it's 20 minutes. And then they ramp it back up, and if it hits 13%, that's a level 2 circuit breaker event, and they halt trading for another 15-20 minutes. And if it gets down to 20%, and this has to be relative to yesterday's close, so it's down 7% relative to yesterday's close, or 13% relative to yesterday's close, 20% relative to yesterday's close. That's a level 3, and they just halt trading, period, for the day. And they're thinking, the theory on this is that it, it stabilizes the market. That's the theory. Now, I personally don't think it stabilizes the market. I think it creates more panic. I mean, what's the most panicky news you can hear? Oh, market trading was halted because the circuit breakers were hit. I mean, that freaks people out. So then when they start ramping it back up, what's everybody want to do? They want to sell the crap out of it. No one wants to buy. So, I'm not sure that the circuit breaker theory here is going to help a panicked market. That's the circuit breaker theory, and that was not hit today. There's a lot of rumors that it did get hit. It did not get hit. They never halted trading. Now, what did almost happen is they almost reached the 7% point down here, but they never hit it to the point that it halted trading. I think the level was 15.3, somewhere in that range. Well, we were there. It was just right below. I mean, we were within 100 points of hitting the circuit breaker today, but it did not happen. Now, the Rule 48 is it's a mechanism that they put in place to ease the market opens. And they would implement this in a case of what they saw this morning, heavy international selling overnight, heavy futures selling overnight, circuit breaker having been tripped the day before, stuff like that would instigate a Rule 48 usage, and that was used this morning. And what that is, and this is part of those weird bid-ask spreads, what it is they don't have to quote the opening price. So whenever you get up and you look at the market, they have to quote the opening price before they can start trading. What they were able to do is start the trading without quoting the opening price, and that's why you had so much volatility first thing in the morning, because nobody really knew what was happening. And a lot of the quotes that you saw, like you saw Apple getting quoted at like $87. I think that was the bid, was 87, but I don't think it was ever, maybe ever transacted at that price. I might be wrong on whether it actually transacted or not, but that's what you'll see, is you'll see these just wide bid-ask spreads, and part of that is that Rule 48 thing. So here's the way that the market looked today. We opened up and we just rallied. Oh, wait, this is wrong. What am I looking at here? This is the wrong 5-minute chart. No, that's right. That's right. Sorry. It was so shocking for me. Trying to figure out, because I'm not seeing the gap from this. Yeah, I'm not seeing the early morning. No, this is wrong, because it's showing that we rallied up to 17.5. So something's wrong about that picture there. I must have data that didn't update right. Well, let's try another chart. Let's see if something else printed the tickers right. That looks right. So the S&P is looking right. For some reason, my Dow data is not right, so we'll have to reload that. But here's the way it looked this morning. This is a 5-minute chart. And all that selling volatility was in the first 5 minutes. So take a look at that picture right there. This is what I was wanting to show you. It was the first 5 minutes. They were easing the markets in. And if you watch the actual Dow ticker this morning in real time, it took 4 or 5 minutes to create that candle, and then everything started going the other way. That's part of what that Rule 48 does. That Rule 48, they couldn't really see what they were quoting, and initially, Dow's only down like 0, and then it's down 100, then it was down 200, then 300, then 400, 500, 800, rallied a little bit, 900, 1,000, 1,100, people are freaking out here, and then it just started to steadily rise throughout the rest of the day. Well, there's your little corrective wave, and the concern is that towards the end of the day, it came back in. And when you look at the S&P, it's actually a little more scary looking than the Dow. When you look at the S&P, this looks very much like it's a continuation, and so I am very much prepared for this to continue bearish tomorrow. This is the S&P picture here. And if that happens, then, so be it. That's what's going to happen. But at some point, whether it be the end of the day tomorrow or whether it be Wednesday, somewhere in here, it will start to rally. And that's how you end up with a candlestick that looks like this right here. So we opened up this morning, sold off in the first 5 minutes to here. We rallied, and then at the end of the day, we're not selling at the very lows, but we're selling pretty low there. That help you guys out there? Just kind of have some insight there. Okay. All right, let me, I may or may not get through all these questions. I'm going to start working through the flagged questions. Some of these came in a long time ago, so I'm just going to start working through them. Coming back to Deborah back at 7:21 p.m. She says, you keep calling this a bear market. There's a distinction between a correction, which I thought this was, versus a bear market, which in my mind lasts anywhere from 10 to 18 months. Am I wrong? Deborah, that is an awesome question. That is a great question. I don't know if anybody was watching CNBC this morning. I'm not usually a big fan, but this morning it was, I kind of had to. It was too good of entertainment to not watch it. And they had a guy on there, Tom McClellan. A couple weeks ago, Josh shared with you guys the McClellan indicator, and McClellan oscillator, I should say. And McClellan and his dad do a lot of research, and some fantastic research. I mean, just top-notch research. And I'm telling you what, Tom McClellan schooled the CNBC anchors this morning on what is defined as a correction and a bear market. Deborah, thanks for asking the question. And what he told them is totally right. And what he said to the CNBC anchors is he said CNBC should fine you every time you say we're officially in bear market territory, or every time you say we're officially in a correction. And then here's what he went on to say. He said bull markets all have corrections. These are all corrections, Deborah. And he says bear markets all have corrections. These are corrections, Deborah. And so, Deborah, whenever people say it's a 5% correction, or it has to move at least XYZ in order for it to be a bear market, what they're doing is they're putting a specific level at it that doesn't make sense. Deborah, here's how a correction is defined. You ready for this? A correction is any move that is contrary to the primary move. Any move that is contrary to the primary move is a corrective move. It's that simple. So if the main move is bullish, any move that is bearish is a corrective move. Any move that is bullish is in direction with the primary move, and any move that is corrective is a bearish move, or is anything that's contrary is a corrective move. Now, how do we define a bearish trend? A bearish trend is a sequence of lower lows and lower highs, Deborah. Lower low, lower high, lower low, lower high. And we have that on the Dow, and now we have that on the S&P. Lower low, lower highs, lower lows. When it bounces, we'll have a lower high. You cannot come back and say that the S&P is in bullish territory until we've made higher highs. You can't do it. And so, Deborah, here's the way the new terminology is going to go. You ready? When you hear me talking, Deborah, I'm going to say a corrective move, and I'm talking about a little bullish move that looks like that. Because I'm on the belief right now that we're in a bearish move. Now, whenever you talk about 10 to 18 months, you're talking about what we would qualify as a primary trend, Deborah. And yes, primary trends tend to last 10 to 18 months, but do you want to wait that long to identify it so you can trade it? No. You want to identify it early. So Deborah, you unfortunately have been indoctrinated by the news media who likes to throw out really poor definitions. And I'm not beating you up, Deborah. I'm hopefully bringing some clarification. Yes, we're in a corrective move right now. It's corrective to the big picture trend that started in 2009. And inside this bearish corrective move, we're going to have some bullish corrections that come in to correct it. But the overall bearish move has not ended yet, I don't believe. Does that help you out, Deborah? Does that put some perspective on that? Maybe a retracement is a better terminology, but you know, retracement and corrective are the same. Does that help you out there, Deborah? And I hope you don't feel like I was beating you up. I wasn't. Okay. All right, let me move on here. We're probably going to go late, guys, so just so you know, we're probably going to go late. Roger says, could you show the advanced decline numbers? I can't. I'm sorry. I don't have it on this machine. I should, but I don't. So, Roger, I can't do that. But I guarantee you, Josh will be looking at that in great detail tomorrow night. In Josh's trading lab, I assure you, he will be talking about market breadth in great detail tomorrow night. Larry says, I bought calls in the VIX last Wednesday, a straddle in the diamonds last Wednesday. Sold today 15 minutes after open for a great win and still have a long leg straddle. Good job, Larry. Hey, Larry, let me just give you a heads up. The VIX does not trade American style. So I'm sure you made money on it, but it doesn't trade American style. American style options give you the right but not the obligation to buy or sell on or before expiration. VIX options give you, or European style, and the definition is it gives you the right to buy or sell on expiration. So Larry, when I traded the VIX options for the first time, I learned the hard way that you know, my VIX went up substantially. I thought I was going to make a bunch of money on it, and I got moving. Unfortunately, my premiums didn't go up as much as my VIX did, and I'm thinking it doesn't even have intrinsic value here. What's wrong with this? And I didn't understand the first time that it was looking at, will it be there at expiration? Well, I held it to expiration, and no, it was not there, and ended up losing money on it. Here's the other thing that's strange about VIX options. They expire on Wednesday, not Friday. So, Larry, there's a couple distinctions about VIX options you should be aware of. John wants to know, what you have not addressed is the dramatic reversal that happened after the Dow dropped 1,220 pre-market. Suddenly, short sell restrictions were imposed across most market underlying, followed by a dramatic uptick in the index and many major stocks. Excuse me. Ooh, sorry, choking on my drink here. John goes on, can you explain what accounted from that very quick reversal? Program trading, I presume. John, I cannot. John, are you talking about today? Maybe I missed something. I didn't think short sell restrictions were imposed. Maybe I missed something. Since I'm primarily trading options, I might have just missed that. And I never saw a tick at minus 1220. So maybe I'm missing something. We might be talking about two different things here, John. Now, what could have accounted for all that? Program trading might be part of it. But I think it's just the general, people get their triggers set up. Oh, another thing I forgot to talk about, one of the big things that helps spur on a sell-off is margin. I meant to talk about this in my opening discussion. We are at the highest levels of margin debt in U.S. history, which means more people own stocks that they bought with margin than at any other time in U.S. history. What happens when those stocks start to go down? Margin calls and people starting to freak out because they're losing twice as much as they thought they were going to lose. For some people, they didn't lose, 4 or 5%. They lost 10%. For some people, they didn't lose 10%. They lost 20% because they were buying on margin. So that rush to cover margin can be part of the reason. It is one of the reasons that bear markets sell off as quickly as they do. Okay? I'm not sure if that mattered to any of you, but I thought it was important for you to know. Michelle, she says, are you still bearish on Starbucks? That's a great question, Michelle. And Michelle, here's the answer. I'm not really bearish on anything anymore. I don't know if you got that from my market overview. I don't think I'm going to take another bearish trade this week. I seriously doubt I will. I am watching for a bottom, and I'm watching for some counter trend trades. Now, long term, am I bearish? I'm bearish intermediate to long term, Michelle. Michelle, I don't think I'll take another bearish trade this week. I'll be surprised if I do. Now, if something sets up, I probably will, but right now, I would not expect that I would do that. All right. So Michelle, is that, before I even go on, is everybody clear on my position on the market? Or does anybody doubt where I'm at? I am specifically in the very short term, I'm looking for a bottom, and I'm looking for a bounce. So that means that in the short term, I am neutrally bullish. But that, do not mistake that for a more intermediate picture. Intermediate, I am very prepared for a big bear market. Does anybody miss that? Really want you to know that. So I would not recommend you rush into a bunch of puts tomorrow. I would recommend you kind of let the dust settle a little bit. Let's find the floor. It's got to be close. I expect it's close. I mean, if we have another 500-point down day tomorrow, well, here's what I can tell you. If we have another 500 points down tomorrow, I can almost guarantee you Wednesday will be about 500 points up or more. I mean, you can't have 4 or 5 of these back to back and not see a snapback. We are so far. I didn't show you this. We are so far from the standard deviations. Look how far we are outside of the Bollinger Bands. I mean, and look at your %B too. I mean, we're just. I don't think we've ever been this far out of the Bollinger Bands. So somewhere in here, we've got to have that fast, sudden surge right back inside those bands there. So look at your %B. I mean, I don't know that we've ever been this far out. I could be wrong, but man, that is maybe, well, it says maybe back in January of 14, but I don't see being that far. I mean, we are just nowhere even close to the bands here. This is a long ways out. By the way, this could be an opportunity to do some bull put spreads. For those of you who want to trade credit spreads, you might, once you start to see this floor built, when that floor gets built and you're going to have a week or two of corrective move here, moving higher, retracement, that might be an opportunity to do some bull put spreads. You have high volatility. You'll be trading counter trend. I mean, you could get into some of that. Then whenever bear markets resume, you might look at the bear call spreads. So that they're, from a spread standpoint, those are some opportunities. All right, Gerald says the inflation-adjusted chart. I don't think I have an inflation-adjusted chart there, Gerald. Margaret says that appears like a 5-wave sequence, the one that you labeled B, would you say? Marcus, I think that I would say that, yes. I would. Lisa says, can you explain what some of the unusual terms used today? Yeah. Uptick 97 rule. I'm not familiar with the 97 rule, Lisa, so I cannot speak to that. Uptick, I'm not sure where you heard that in context, but uptick just simply means that the market ticked up, that it was a buying tick that moved higher. So was there other terminology that you wanted me to explain? I'm happy to address those, Lisa. You can type them in there. The 97 rule, I'm not familiar with. The one that most people have asked about was the 48 rule, so I addressed that. Yah says, why is today's Dow Jones industrial candle so different than the diamonds? Because the industrials is an index, and the diamonds are the ETF. That doesn't make any sense to you, but what happened is when the diamonds commenced trading, the index had already gotten down here, so they opened up down here at 156, whereas the index, it's just kind of the way that it gets drawn, Yaz. I mean, I don't think I'm explaining this very well. The diamonds are a derivative. They're derived from the equity positions that are in the industrial average. So as all those positions were getting ramped up, most of those issues gapped down, and that's how you ended up with a big gap down here on the ETF. But the industrials itself, if you watched it this morning, they didn't just let it quote the price. That's where that Rule 48 came in. They had an orderly open, so you saw the full candle get built, Yaz. Does that make sense to you, Yaz? Hope that made sense to you. All right, let's keep working through some of these here. Joe, in what order do the sectors react indirectly to the VIX, Dow, S&P? Joe, you got me. I don't know that there is. I'm not sure I can answer that one intelligently, Joe. I'm not sure I fully understand the question, actually. In what order do the sectors react? Joe, what are you trying to get at there? I don't think I understand the question. If I do understand it, I don't know the answer. But Joe, if you want to try that again, I'll be happy to try to give you a good quality answer. Hey, listen, we're coming upon the 8:30 time, 8:30 my time, 9:30 for those of you on the East Coast. And I know that some of you need to go. So I'm going to answer the rest of these questions. I'll keep working through these. But if you need to go, I want to just kind of give you, feel free. We'll just do some more Q&A as we keep going through the rest of the time here. Also, I don't know if you've seen it yet or not. I'm not sure it went out, but we're making a big announcement today about a new online trading conference that we're putting together starting here in 2 weeks, and I want all of you to attend. So please come to the conference. We're including it with your memberships, and we're also letting you bring friends, and it's going to be online. Tell your friends about it. You should have an email. If you don't already have it, you should be getting it sometime later tonight. It's called the Ignite Online Trading Conference. I'm really looking forward to it. I'm as excited about this as any of the stuff we've done before. I think you guys are really going to love it, and I think it's going to be a huge value add for you. So make sure you see that. Make sure you share it with your friends and family members and whatnot. So just wanted to make that little announcement there for you. And again, as a member here, well, actually, Josh and I decided that we're not going to charge for it. We're going to let your friends and family even come for free. We were going to include it for members. We were going to charge external people who were not members, but we've decided to open it up. We just feel like it's going to serve the community better. So go ahead, tell your friends and family, get them involved. You know what we do. You know it's going to be top-notch, and so looking forward to that. All right, let's keep going here. Lisa, if you need to leave, I understand, but I'm going to keep answering questions. Lisa says, what site are the futures being listed, and are they delayed? Lisa, you can go to CNBC, and you can get futures quotes. You can just Google futures quotes. Bar Chart has a decent futures quote. They actually have a better app for it. Who else has? There's a lot of people that have futures quotes, Lisa. Lots of them. Just Google futures quotes, and you'll get a quote. You'll find several people listed. But CNBC's got one of the better sites for it. You can get that on your phone, and they've got a good mobile site as well. Works well on your phone. Albert, Albert says, would worse conditions in China mean the Fed might not raise rates? You know, Albert, I think it's speculation. I'm not sure that we really know what the Fed is thinking. So, Albert, I don't think that I can answer that question. I wish I could, but I don't think I can give you an honest answer. So I could make one up if you want, but that's probably not the right thing to do. Carol says at 8 o'clock, can you go over some of the new vocabulary? Carol, I tried to hit on a lot of that. Is there anything left in the vocabulary that you don't feel like I hit that I could help you out with? If so, type in some of those things that you might have heard, and I'll be happy to try to address those if I can. Jeromy Revere says, why did Ford almost have to close their trading session? CNBC said something about 7%. Jeromy, that's the circuit breaker. Did you hear me explain that earlier, Jeromy? You still here, Jeremy? If you are, let me know if you heard that explanation about the circuit breaker, and that was the reason. So it's the circuit breaker. Okay. Travis said, "Can a stop ever fail?" I think I already answered that, Travis, actually, because I remember reading it. He said, "Can a stop fail during a circuit breaker?" Travis, if trading is halted, yes. Travis, here's the other way that a stop fails. You ready, Travis? Travis, let me know you're still here, so I know you're hearing this answer. Travis, are you still here? Okay, Travis, here's how a stop can fail. If you set your stop with a limit order and there's nobody that wants to take the price at your limit price, that's when the stop itself didn't fail, but the trade will not get filled. And that's when people would say a stop failed. So a stop itself is really just a trigger that says when the stock hits this price, then sell the trade. If you sell it at a market order, then it should be filled. If you sell it as a stop limit, it may not get filled, Travis. And a lot of people refer to that as my stop failed. No, your stop didn't fail. You just set a limit order and nobody wanted to take the trade at the price that you put in there for your limit. Susanna, she says, "I took the Trade Smart shorting class, but you did not talk about the uptick. I don't understand it clearly. Can you please talk about it?" Yes, Susanna. The uptick rule is a rule that says that in order to short, you must short on an uptick, which means that there's somebody that's buying. You're not just shorting and driving the market down. Now, a couple of years ago, they took that uptick rule away. Maybe I missed something. Maybe they reinstituted it and I missed the memo. But that's what the uptick rule refers to, Susanna, is that you have to short on an uptick, which means that you're shorting in basically in orderly markets, not in panicked markets. So maybe I missed the memo and the uptick rule's back. But my understanding is they took that away, so I never ever talk about it anymore. Who does the halting? Pierre, halting is done by the New York Stock Exchange and, you know, the regulators, not regulators, but the exchange overseers. And no, trading was not halted today, Pierre. It was not halted. Audrey says, "I was told that stocks are not being traded and are just being held for dividends. Should just be held through everything. Since I usually trade stocks for profit, I find this difficult." Audrey, I'm not sure I read that correctly. You were told that stocks are not being traded and that they are just being held for dividends? That is not a true statement. Stocks are being traded all day, every day. I'm not sure if that's what you meant to say. You might have intended, Audrey, to say that stocks are not meant to be traded and that they should just be held for dividends. Is that what you meant to say, Audrey? And if you meant to say that, I would disagree with that sentiment, although there are a lot of financial planners who prefer to say that. But I don't agree with that sentiment. I say when you got a profit, take your money. That's my sentiment. But stocks are very heavily traded, and that's what everything happens all day, every day. Ralph, the answer is yes. He wanted to know if the Rule 49 is what he wrote in here. The Rule 49 was the reason for slow data feed for the first half hour. That's exactly it, Ralph. What's your support on the QQQ, says Mark. Mark? Mark, you here? QQQ support. Well, I had one at 90. About where we are, Mark. I mean, we are, I'm telling you what, guys, we should, in the next 2 trading sessions, we should hit the bottom. At 85, we traded down to a major support. And, of course, we closed way up here. My ideal target would have been around 90. Here's what you guys should look at. Look at the October 2014 lows. Those were my ideal targets. So just so you have a reference on that. Those were my ideal targets. Brian says, is there any significance to the fact the bearish candles progressively get longer than the previous candle? The significance is that the sentiment is building, Brian. So yeah, there's significance to that. What is limit up and limit down? All right. Did anybody hear limit up and limit down today? Limit up and limit down is something that happens in the futures markets. And, you know, I'm not a futures trader, so I don't have everything memorized. I'm going from memory here. In the futures market, overnight limit up and down is 5%, I believe, for equity indices. Now, different futures contracts have different percentages. But in the futures market, I think overnight is 5% up or down. And during the day, I think it just follows the regular, what am I trying to say, circuit breaker rules, which is 7, 13, and 20. But here's what limit up and limit down is. In the world of futures, they put a limit on how far a contract can trade during any given day. And the outcome here is to stop the panics. So you might hear oil traders talk about this. You don't usually hear it with index futures, but you'll hear it with, you know, well, any of the other futures. You'll hear it with oil. It's a very volatile futures contract. It's probably the one I've heard it with the most. But, you know, if corn suddenly has a big spike or a big sell-off, you know, you'll have limit up or down days. And what a limit up or down day in a futures world is, it's the max that the contract can move during that day. And when it gets there, it can't go higher or lower. And so basically trading is halted. Now, here's where it really hurts you. And if you're a futures trader, let's say you're long a futures contract and the market limits down at 5%, and you want to get out of your long contract, but you can't. And then the next day, what will happen is it'll open up, and oftentimes it'll immediately limit down again. And I've heard horror stories from futures traders who are trying to get out of their contracts, and they can't because they reached limit up or limit down, and that basically halts trading, and there's no liquidity. So that's what limit up and limit down refers to. That's in the world of futures. Gail says, so are we now in a primary bearish trend or still in a bearish correction in the primary bullish trend? Yes. Depending on which level of the trend you're looking at, Gail, the answer is yes. If you're looking at the daily chart, I would say you're in you're beginning a new primary bearish trend. If you're looking at the weekly chart, I'd say it still looks like it's a little bearish correction, but it's a pretty big one. And so you're setting up for however that's going to trade and flow out. Does that help you out there, Gail? You clear on that one? Firecracker Pat. Interactive brokers instituted short sale restrictions. I did not realize that. But that was an individual broker. That was not done by the exchange, I don't think. But I will research that and find out, because I did not realize that had happened. Jay Newell says, short term is defined by what time frame? That is a great question. That is a great question. For me, I'm thinking short term on a daily chart. So that would be a minor level trend. That would be a few days up to 2, maybe 3 weeks. So minor level trend on a daily chart is what I would call short term. Intermediate level trend will be a few weeks up to maybe 2 or 3 months on a daily chart. And a primary trend will be, you know, typically a year or more. Does that help you out there? Martin says, when the price of the S&P is low and implied volatility is high, why is the implied volatility on the ETF, which is inverse of the S&P, also high, even though its price is high? Case in point, SPXS is the inverse of SPXL. SPXS is very low now, like the S&P 500. SPSL is very high. Both have extremely high implied volatility. Wouldn't it make more sense for the inverse to have unusually low volatility? No. No, it would not, Martin, because implied volatility has to do primarily with the fear in the market. And what a lot of people think of as volatility is a lot of people think that volatility has to do with bear markets. And typically, that's the way the VIX ends up looking. It looks like implied volatility goes higher when you have bear markets. But in reality, volatility covers the uncertainty. So if you have a lot of big swings up or down, it's a high volatility environment, Martin. Did that help you out there, Martin? Makes sense? Deborah, she says, I'm surprised how gold traded today. Thought with the fear it would go higher. Are you still bullish on gold? I am still bullish on gold, Deborah, and I'm not that surprised. You know, the dollar was, well, I guess, you know, you would have thought gold might have gone a little higher with a weaker dollar. But, you know, gold, it's not every day that it's in perfect reflection. It's over the general intermediate trend typically that you kind of get the picture. So, you know, I'm still bullish on gold. In fact, I was just telling Richard before class, I think silver's looking awesome. Very, very low downside risk. Very good upside potential. Silver is a trade that I'm highly considering in the very near term, like tomorrow or the next day maybe. So to answer your question, Deborah, is yeah, I'm still bullish on that. Gail says, I read that trading in stocks was paused more than 1,200 times today. So a pause is different than a halt. Gail, where did you read that? You can send me the article or we can circle back on that. You can email me about it. Jeromy wants to know, does the circuit breaker work for a price increase as well? No. No, it does not. Phil says, you might want to pass this along. I just Googled it. New short selling rules explained. Market beat, Wall Street Journal, blah, 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 blah. All right, so he's got a link here. Sorry, I'll just forward this out. I'll just do it this way here. All right, so thanks to Phil. You guys should all see that link there. Y'all can go look at that. And that was the 2010 update, so probably beneficial to refresh that. Helen wants to know, how many % down is a crash? Well, I think today was a crash. I don't know that there's a hard percentage, Helen. I think any time that you get caught off guard and traders are feeling beat up, I think you can call that a crash. You know, I think, you know, a lot of times the popular news media, you know, they like to put absolutes. They like to say, well, if it's down below the 200 period, then we're officially in bearish territory. Well, I think you're in a bear trend if you got a sequence of lower lows and lower highs. So, you know, I think sometimes, Helen, people, especially the news media, likes to put absolutes out there. And I think anytime you're feeling beat up and you don't see it coming, I think that's a crash. That's my opinion on that, Helen. I don't know that I would take that to the grave with you, but that's my opinion. David says, oh, he's got a link in here. We'll check that out. I'll look at that after we hang up the show here. All right. Rick says, CNN said that trading halted over 1,200 times. Maybe those were on some individual trades that were hitting individual circuit breakers or something. I got to look into that. I missed that somehow. All right, Paul, please draw head and shoulders on the Dow. Okay, I will do it, Paul. Paul, I don't know if I can. It's going to be sloppy no matter what I do, Paul. But here's what we could do. What we could do is we could say left shoulder, head, double right shoulder, breakdown. I don't think I would do that. If I go to a weekly chart, I don't think you can get more of a rounding top on a weekly chart. I don't think you got a real head and shoulders here, Paul. Well, actually, that one could. No, you can't. No. No, you really don't have a head and shoulders. I mean, if this current sell-off had rallied back up like so, then you could have had a head and shoulders. But I don't think you're going to have a head and shoulders on this one. It's going to be a different top. Probably somebody's going to come along and call this the textbook rounding top. That's what someone's going to do. I mean, this is just a top. It's just kind of rounding out. If you want to put a pattern to it, maybe a rounding top. I think probably a double top is probably the better way of looking at this. I don't know. We have to split hairs over how we name it here. On the daily chart, it was really a consolidation, though. I mean, it was just a clunky consolidation that took all this time to get developed. And for those of you who care about wave counts, we're counting the top in May as the top of wave 5. So that's how we're looking at that. And there's 1, there's 2, counting that as 3. So we're looking at 5 waves down here, and that's an impulsive wave, which is a bearish trend. All right. Is there anything else I need to talk to you guys about? How are you guys feeling? Are we walking away with some ideas about how you can be better traders in this market? Are we walking away with some better ideas of what to expect? Are we walking away with maybe a little bit better peace of mind tonight? How you guys feel? Anything else I can help you with tonight? Okay, good. I really want you guys to, I'm going to end on this here. I really, really want you guys to not feel panic. It will not serve you. It will not serve your bank account. It will not serve your financial well-being. I want to encourage you to recognize that this just is. If you look at a natural event in weather, you look at a strong thunderstorm, does anybody freak out that it's about to rain 12 inches in the next 24 hours? No, they just say, hey, big strong thunderstorms are coming through, and be aware of it. Does anybody freak out about a flood if the street doesn't drain that fast? It's not really that big a deal, except for the person who decides to drive through that street, and then whenever their car or truck washes off, they have to initiate a rescue. In the stock market, I think people get caught off guard because whenever the storm clouds start to build, nobody wants to believe it's coming. And then when the rain starts to fall, everybody says, wait, I'm getting wet. But it's natural. Bear markets are natural. So when it rains, you use an umbrella, you wear a raincoat, you get in out of the wet. In a bear market, you buy puts to hedge yourself. or you go to cash, or you go to cash and you buy some bearish positions. It just is. And as long as you flirt with the idea of getting emotional about it, you're going to have really bad results. But if you can get outside of the emotion, you're going to find that it just is. It's just part of natural market cycles. It will go down for a while, then it will come back. It will go down, and it will come back. And you can choose to hold all the way through the bottom, and one day it might come back. You know, the question is, how far is the bottom? You know, if the bottom's 5,000, it might take you a few years or decades to get back to 18,000. So most people prefer to try to sell at the top, and that's generally what I would suggest. I prefer to not hold through big sell-offs. So I guess those are my closing thoughts. Don't get overwhelmed by what is natural. Rather, ask yourself, how can I manage what is natural? And if you do that, you can fare through whatever market conditions happen. And maybe we're all lucky. Maybe I'm wrong. Maybe there's not a sell-off to 12,000. Maybe there's not a sell-off to 10 or to 4 or 5. Maybe that doesn't happen. Maybe we're all lucky and markets bounce from right here and we're at 20,000 by Christmas. That would be great. It would be awesome. But it would not be responsible for us to not talk about what we see. So you've heard my opinions tonight. You see where we are. If I see anything different, if I think we're going to have big bull markets, I'll certainly talk about it. But right now, short term, a little bit of a bullish rally, and then I'm looking for some more bearishness to come in. All right, guys, that's it. That's all I got for you tonight. You guys have a wonderful night. Happy trading to all of you. Until we meet again, Trading Labs tomorrow night with Josh. I'm sure he'll have some great stuff to add with market breadth. And I'll be here for Power Trader Sunday night. Of course, Alfonso will be here Thursday for his Trading Lab as well. So you guys have a great night. We'll see you next time. And until then, happy trading. Good night.